Well, it's Federal Reserve interest rate decision day. They're widely expected to raise rates by 25 basis points or a quarter percentage point. But what's important is that expectations matter more than the actual number that comes out. How much they raise rates matters less than the difference between what expectations were and what they actually do. If it's widely expected that they're going to raise 25 basis points or a quarter percentage point, investors position for that. So everything's set up for a 25 basis point interest rate increase. So if they exceed that, that's very good for the dollar, very bad for oil and gold. And if they don't raise rates at all, so they do less than expectations, that's going to be tremendously good for gold, pretty good for oil, very bad for the dollar. The same thing happens with stock market investments. For example, if a company is expected to make $1 per share in earnings, but then they make $2 a share, the prices go much higher, of course. But if they're expecting to make $1 a share and they make 50 cents a share, the price comes down. And a lot of newer investors get confused by this because they say, if a company's making money, making a profit, and they release that, why do the share prices decline? It's because the share price was pegged at a level everyone was expecting of $1 per share in earnings. And then if they didn't make the $1 a share in earnings, then the price comes down because it's expected that they would have made more. If they're expected to make $1 a share and they make $2 a share, the price, of course, will skyrocket. It's all about expectations. They're more important than the actual number that comes out. That's why if they raise interest rates by 25 basis points or a quarter percentage point, it won't have as much effect because everyone's already positioned for that. Nothing in this video should be taken as personalized trading advice for you. And where the opportunity lies in the investment world is when their decision is different than expectations. Anything they do other than raise interest rates by 25 basis points will have significant effects for investors. And you want to be positioned properly, but you also want to be right. If in fact they don't raise rates at all, the reason they would do that is because of all the commotion we're seeing in this worldwide banking crisis that's getting worse and worse. There's some problems underlying what you're hearing on the news. A lot of things are going very badly behind the scenes. We'll even get into a little bit of this with these headlines we're going to go through. You want to get more information like this, great content, all you got to do is subscribe to the channel. We're going to help you guys out the whole way. Treasury Secretary Yellen says the government could backstop more deposits if necessary to stop contagion. They need to reassure the markets and say we'll do whatever we have to do to stop all these bank runs that are on the verge of happening. Their job is more about calming the market than anything. It's not about what's best for individual middle-class people in America. It's not what's best for individual investors. It's all about keeping the system from crumbling. Confidence in the banking system has taken a major hit. And a lot of what the Federal Reserve is going to do now is about calming down the markets. And Treasury Secretary Janet Yellen is not part of the Federal Reserve. She used to be, but she's not now. But their job, between Yellen, between the Federal Reserve, between the government, is to calm everyone down so people don't pull their money out of the banks. Because as you can see, when people lose confidence in the currency or they lose confidence in their banking institution and they all pull money out at once, that's very detrimental to the bank itself. Most of these banks wouldn't be able to survive a bank run. And if you watch my previous video about some of the things Janet Yellen said when they were grilling her on Congress, was that she said basically, we helped SVB Bank and not other smaller banks because we decided, as a group of us, including the president and a few other people, and her reasoning is just basically saying, we decided it's in our best interest to give a bunch of money to one bank and stop the contagion. This is another example of what I'm talking about, how capitalism died. And again, you should go see my video about capitalism, how it can solve all these problems. But we haven't had capitalism in a long, long time. And I say it's the day that capitalism failed, but I've already used that headline ages ago when capitalism did die. When you see things like too big to fail, or bailing at one company and not another company, or bailing at one bank and not another bank. Capitalism died decades and decades ago. And that's why everything is getting worse since then. They make a single incremental decision that they think is best in the moment, probably best for them in the moment, but it's a complete violation of capitalism. And that's why things are just getting worse and worse and worse. Capitalism is the only thing that can pull us out of this. And Yellen's going so far as to say, okay, we're not going to bail out just certain banks that we deem worthy. We'll bail even the smaller banks if we have to. She's basically saying, no matter what, we'll do whatever we have to do to stop bank runs. But bank runs are based on the psychology of groups of people, not on decisions by bureaucrats. For many of you, this is your first time here. My name is Peter Leeds, and along with my entire team, we publish the world-famous Stock Pick newsletter. We've been doing this for over 25 years, and we've got subscribers from 6 different continents. You can get all this information for 55 cents a day. Everyone's talking about Credit Suisse's risky bonds. Here's what they are and why they matter. As part of the takeover of Credit Suisse by UBS, Swiss regulator FINMA said $17 billion worth of additional Tier 1 bonds would be wiped out. $17 billion of bonds are just wiped out worthless. That is a default with a capital D. This is part of the default deluge I've been talking about for years now, coming up to this point. The $17 billion wipeout of Credit Suisse bondholders has not gone down well in Europe. This is from CNBC. The Swiss regulator, FINMA, announced that so-called additional Tier 1 bonds will be written to zero as part of the deal. The move has angered Credit Suisse bondholders as their investments have seemingly been lost. They're not seemingly lost, they're lost. They soften the language because it's too hard to give the tough news that you've lost your money. So they say they're seemingly lost. This stock could go down. This stock could go up. That's what they do. Virgin Orbit scrambles to avoid bankruptcy as deal talks continue. Contingency planning is underway for a potential bankruptcy filing as soon as this week. And the reason I'm telling you about this headline, I'm just going to throw in a few headlines when I see them, about the way the economy is going as expected. There's defaults, there's write-downs, lost money on bonds, and you'll see delinquencies and bankruptcies rise as well. Next holiday quarter plagued by bloated inventory, weak China sales. As night goes, a lot of other retailers are going to go as well. And as I told you ages ago, there's going to be these big inventory gluts, and that includes automobiles too. You'll see that eventually. As I always say, just wait. Amazon to lay off 9,000 more workers in addition to earlier cuts. So when they lay off 18,000 people, now Amazon comes along and says, okay, that wasn't enough. We've got to lay off another 9,000. First Republic jumps 30%, leads comeback rally in regional banks Tuesday. Regional banks were taking such a hit because of all the banking crisis that's happening. And the regional banks, a lot of money was flowing out of them to bigger banks because the bigger banks were being backstopped by the Treasury Secretary's comments. And of course, when there's blood on the streets, you're going to see a bounce when you come out of that. But I'm not sure that we're done with this banking crisis. I think it could get a lot worse. I'll make a dedicated video about exactly that topic eventually if I feel like it's required. But think about that expression, when there's blood in the streets. There's blood in the streets right now with a lot of investments, specifically the banking sector. That's where, if you want to try and catch a recovery bounce, you want to be looking at that industry. Things at first, when the news comes out, the bad news, SVB, Silvergate, that's when the entire sector takes a hit. A lot of contagion effects happen where stock prices are going down across the board. It's market risk, not company-specific risk. When SVB blew up, that's company-specific risk to SVB. But it spread to the rest of the banking sector, and so the entire sector took a hit. It was trading in sympathy. And then when the news first comes out, it's a lot more shocking. There's a lot more instant result from investors, either selling or buying. And then typically what happens is that as the news gets absorbed, digested, a few days pass, a lot of times a lot of the stocks that took the biggest hit will start recovering. And that's what you're seeing with this 30% increase in First Republic shares.